Good morning, good afternoon, good evening. Whenever you're listening to this, whether it's live, whether it's on replay, we're talking about mortgage rates. A lot of people are excited, jumping for joy. Over the last 4 weeks, mortgage rates have come down quite a bit. Let me just show you a quick graph and then we'll talk about it. More importantly than mortgage rates going down, I want to talk to you on why you don't necessarily want to root for mortgage interest rates to take a humongous dip too fast, especially if you're in the market to purchase as an investment or as your primary residence. Maybe you already bought and you don't plan to buy anything in the next few years. In that case, interest rates coming down, you probably are okay rooting for them because you'll be able to refinance into a lower rate. Your home will probably appreciate as lower rates cause demand and cause bidding wars and things around you sell at a higher price. But take a quick peek-see-poo right here. This is mortgage rates starting back from January. And we peaked our little head above 8% not that long ago. It was only about 6 weeks ago. October 19th, to be exact, 2023, 8.03%. And since then, we've had a pretty good 6 weeks. Mortgage interest rates have come down quite significantly. Mortgage News Daily, a great resource to give you an overall nationwide average. Most lenders, if you've got great credit, you're going to be paying a little bit for this rate. This might be the average of where things are being locked, but they're being locked at a 0.5 point cost or 1% cost. But just it gives you a good idea of where interest rates are at. Another chart that I'm going to put up here is the relationship between mortgage interest rates and purchase demand. And what you're going to see is going to help drive home my point that you might not want, especially if you're in the market as a buyer, to root for mortgage interest rates to come down fast and hard. Fire away with your questions in the comments, whether you're on LinkedIn, Facebook, on YouTube. If you're here in real time, I'd love to get some feedback from you. I'd love to answer questions real time. I've only got 30 minutes today. We've got exciting Monday in the office with a bunch of different loans to get set up and locked. So while you're here, fire away real-time questions because I think they're valuable for you while you're here. A Google search might yield you a result that's a year old. I want to give you the answers in real time. But check this out. This is the yellow line that you see in the background is the 30-year fixed rate mortgage this year. And the funny part is it's like the weekly average from Fannie or Freddie or somebody. So it's where things are being locked. And so it's not, it doesn't hit that 8% peak because, you know, people are buying it, builders are buying it, whoever's buying it down. But still, you get to see the relationship, and that's the point of bringing up this graph, between the 30-year fixed rate mortgage and the purchase index. Let's start here in mid-September at 7.19 and a purchase index of 147. Interest rates go up, purchase index go down. To think about this really simply, when rates go up, purchase demand goes down. And like, it couldn't be any clearer than the last 8 weeks. We get here near the peak, and we also see the trough or the bottom of the purchase index at 125. Then rates come down, and what do you know? Purchase index goes up. This is going to help drive home the point that I want people to hear. If you hear nothing else from me, I said it this morning, talking to my friends from the hub, one rental at a time. I said it in a video I recorded for my YouTube channel, which hopefully you're subscribed, like, comment, subscribe, do all the things. If you're in the market to buy a home and you're in a market like we're in, Sacramento, and I say we because I just saw my buddy Ryan Lundquist in the comments, we're missing 1,000 plus. I think that's the number, Ryan. Like confirm if that's right. We're missing 1,000 plus listings. So there's not a lot of supply. And with very little supply, as this purchase index climbs up, which it will, it'll go even higher if mortgage interest rates continue to go down. It's going to cause the homes that are on the market at 500,000 with first-time home buyers trying desperately to get in their first house. It's going to make it harder for them. Multiple offers, 525, 530, 540, 550. So the people who think that they want mortgage interest rates to come down because it's going to help them with affordability don't understand that as the rates come down, the price will get jacked up. Speaking of my buddy Ryan Lundquist, good to see you here today, buddy. Check out my only other open tab, SacramentoAppraisalBlog.com. All kinds of good info at all. Shout out to Ryan. If you're watching this and you haven't checked out SacramentoAppraisalBlog.com, even if you're not in Sacramento, go check it out. Great stuff. All right. Really need more balance in today's market. It's a good thing for buyers to have rates come down. It's too bad we aren't seeing much relief in terms of more new listings. Yeah, I mean, that's one of my fears, honestly, Ryan, is that we have interest rates come down, which pushes demand higher. And then if we get into February and March, when more buyers come out anyway because of seasonality, and we don't get the new listings, if we don't have stuff on the market to buy, it is going to be very, very competitive. I mean, you don't have to be a rocket scientist. I don't claim to be the smartest guy in the room, but I know when there's a few things and a lot of people that want to buy a few things, it's going to drive up the price of the few things. Missing about 1,000 on any given day. Yeah, and that's for Sacramento. I talk to people around the country. I'm sure Ryan does too. Like, it is a problem to have 15,000 fewer listings hit this market compared to 2019 and prior. I've seen so much Ryan stuff and I appreciate it and I love it. That, you know, I remembered that number from Sacramento Appraisal Blog or something you had posted, Ryan, that were 1,000 plus short on any given day. When you compare it 2019 and prior, you know, 2020 and 21 are years that have an asterisk next to them. And so we don't necessarily compare to those because we had anemic supply because of how fast things were being gobbled up. So, interesting times. And I think that 2024 is going to hinge on mortgage rates. I was talking to somebody earlier today, and there is no glut of supply that can be released that I see. There's no scenario that I see where we're going to get a bunch of new homes for sale. So that's a relatively stable number. But what is going to change is the amount of buyers looking to buy those. And from the charts I just showed, quick look back for anybody who wasn't here, the lower rates go, the more purchase demand goes up, which means more buyers. More buyers equals higher prices, because higher prices are what it's going to take to win a bid. So the theme of today's call, are you sure you want lower mortgage rates, is just saying, be careful for what you wish for. Because you know what I wanted to do, and I think I might try to do it real quick. I want to pull up in the background here. I am going to pull up a scenario. And I'm just going to put side by side a $500,000 purchase and a $550,000 purchase. And we'll just look at what the difference is if you're talking about a 7.5% rate or you're talking about 6.75. I mean, everybody would love to be able to go buy something at let me try this. Well, let's do 10% down. This isn't going to be a perfect scenario, but it's going to be close enough. So 500,000, 10% down. Bear with me while I do this. I think this will be valuable once we do. Would you rather buy today at 500 grand at 7.75? And rates aren't even that high anymore, but I'm just using higher rate for context. I mean, maybe you got a lower credit score. Maybe that is the rate that you would have to take. But would you rather have the 500? And let's do this different. Let's do 7.5. And maybe you got a 704 FICO. Would you want a 7.5 and pay 500 grand, or a 6.625 and pay 550? Because no doubt, especially at those price points, interest rate is going to drive consumer behavior, buyers. And let me see, add this, stop sharing, share screen, share this Excel. There we go. All right. Not a perfect scenario, but 10% down, conventional, assuming a 700 FICO. Let's say that this person today was going to get a 7.5%. And this, quite honestly, would be a little bit higher mortgage insurance. I'm not going to get the exact figure. This isn't an offer to lend. I'm just throwing out some guesses here. But let's say 500,000, 10% down, 7.5% interest rate. Hopefully you guys can see that, and I'll zoom in a tad here. You've got a $3,840 payment. You want to wait till interest rates come down, and they're coming down. You see them coming down, 6.625%. Well, now you got to pay 550 because you got a lot more people bidding against you, and it's a bidding war situation. Not only are you paying more for that home and more monthly, $39.33, but $52 more per month in property taxes, and a higher loan amount. Ideally, you'd go out there and you get a cool deal, 500 grand. It might be 7.5% when you buy it, but then you just slap this refinance onto it, 6.625 when the rates go down. Now you're paying $35.75. A lot better spot you'd be in if you were waiting for 6.625. You compete and you have to pay $550 for it. Now you're paying $39.33. $350 and some change more. So I don't know, just some food for thought. It feels like, I shouldn't even say it feels. The data shows that the decline in rates we've seen is pushing more demand in the market. That demand 100% pushes prices up. If rates continue to come down, prices will continue to be pushed. Michael Mahia, thank you for joining. I appreciate you. Thanks for your help. I was able to buy a new Lennar home. They brought down to rate the 4.99, paid closing costs 2. The higher rates brought down demand, so they made the deal great. Yeah, and that's the thing too. Kudos to you. I talk to people all the time, like Mike, and I'm happy to. If you're watching this and you don't necessarily want to get pre-approved, go to greatmortgagebroker.com. I got another thing you can do. Just fire me an email, matt@mtmg.com. Hey, Matt, I'm looking at this new build. Can we get 5 minutes on the calendar? I want to chat with you about strategy. Cool. I'll talk to you like me and Mike talked. Go in there and negotiate yourself a great deal. Not every deal is for me and the team. There's going to be stuff that builders can do that, quite honestly, we can't. And sometimes we're able to look at it and say, well, they're pretending like they're offering you a great deal, but they're really not. Some cool stories I probably won't talk about here. It's being recorded, but where if the builders are in enough of a tight pinch, you could probably talk them into giving you the terms you want and using the lender you want. So we'll discuss that offline. Jay Homeboy, paying $1,000 more monthly will save me more money on interest cost over the life of the loan. How much more beneficial would recasting every few years if I continue to pay aggressively on principal? I wouldn't worry about recasting it unless you want to have that option of the lower payment. For anyone who doesn't understand recast, I've got a video on recasting here. In Jay Homeboy's case, say he owed $300,000. He's paying aggressively $1,000 a month to pay down that principal. A lot of lenders will allow you, you're into that amortization schedule 4 years, and you've paid it down to $240,000 because he's paying extra on the principal. And not only that, he's got $10,000 that he wants to throw at it to pay it down to $230,000. Most of them are going to make you pay that lump sum, a lump sum of a minimum of $5,000, sometimes $10,000 during the recast. But then you can recast it and say, okay, here's 10. I owe you $230,000 over the last 26 years of this loan. Recast it to give me the payment that it would take, to pay it off, because you're ahead of the payoff schedule. So you're paying your regular payment of $1,550 plus $1,000, and you're down to $230,000 now. After that, they're going to say, $1,550 is not your payment. You could pay $1,300 and have it paid off in the next 26 years because you've paid down the principal. Those are just made up numbers that I'm throwing off the top of my head, but you get the gist. You don't necessarily need to do that, Jay Homeboy, unless it's some sort of thing where, I want to recast this because we're going to turn it into a rental and I'm going to rent it for this number. I want to have cash flow. I'm going to pay the lower amount. But if you're just continuing to throw money at it and pay it off, I wouldn't bother with recasting it. Recasting it's only if you need that option of that lower payment. And so, good on you, saving a ton of money. I need to make a new video that talks about the power of paying extra principal, especially with rates as high as they are. Because when rates are super low, paying that extra principal isn't necessarily going to save you a ton. But if you got a 7% mortgage, you've got $300 going towards principal and $980 going towards interest. You start throwing a couple extra $100 towards principal, you can save yourself months off the loan, years off the loan, tens of thousands of dollars in interest off that loan for sure. So as promised, I got only until 3:30, probably going to jump on it here at 3:25. Fire away with your questions. Kevin Hawthorne from Florida. Good evening. Thanks for watching. Before I forget, another thing I wanted to mention, and I won't necessarily pull up the link, but if you type in equity loan, Matt the Mortgage Guy, on my channel, there is a good video that I made talking about should you get a home equity line of credit or do an equity share. I sent it to a friend of mine who asked because these type of marketers are out in force. People have equity. Not all companies are out there to make friends. I would probably argue that most companies aren't out to make friends. And so homeowners beware is the thumbnail. Cash out refinance versus equity share. Which is better for homeowners? That's my video. I sent that to a friend of mine. These equity share companies are predatory at best. I've seen way too many of them that, hey, no payments. You'll see it on TikTok. You'll see it on Instagram. Like access $500,000 with a little, credit score as low as 550. No payments. The best news, you don't even have to worry about this. Only if you sell or refinance. The problem is these companies are going to have incentive for themselves. They're going to have a way to make money. One company that will remain nameless did an equity share agreement on purchase with a lot of buyers. I happen to deal with a lot of these buyers who were in Northern California and they bought expensive properties. Now it's story time. A couple of clients that just come to mind in my head. $1 million property. They didn't have 20% down. There was a company that said, listen, you put 10%, you put 100,000, we'll put 100,000. So we're equal partners in this. But you know what? Since you're the homeowner, instead of just being equal, we'll only take 42% of the upside. You guys can keep 58 because we're just a generous, nice company. Some of these Bay Area properties between 2017 and 18 and 2021, when I was writing a lot of these refinances, they increased in value to 1.7, 1.8. And so then you grab your calculator and you go, okay, they gave me $100,000. And I didn't really read it. It was just to help me get my 20% down payment so I don't have to pay any mortgage insurance. But my house went up by $800,000 in value. And so they own 42% of that. So I got to pay them back the $100,000 that they let me borrow and $336,000 in equity. That is their share of the equity. And if I don't, I can't refinance. So I was trying to refinance people that had this blank company name equity share agreement in place. It pained me to tell them, listen, you've got a 5.25, whatever the number was from 2017, to go to 3% would save you a lot. $1,500 a month, or some of these cases, it was over $1,000 a month they would save. But they couldn't, because with this equity share agreement in place, they would have to do some sort of cash out refinance to pay off that $436,000 they were set to pay back based on a $100,000 loan. Now imagine someone letting you borrow $100,000 and 4 years later they said, oh yeah, we can square up. You owe me $436,000. Looks like a payday loan. You know, if you calculate that interest, I don't know what it is, but it's high. So beware is my warning. There's going to be all kinds of different products because there's trillions of dollars in what the industry likes to phrase tappable equity. You can tap into it, and cash out refinance only makes sense to a select few. Home equity line of credit is a great option for many, but it has a double-digit interest rate attached to it nowadays, and it requires a payment. You know, you borrow $100,000, you might pay $1,000 a month on that home equity line of credit. But then this option of home equity share agreement, home equity agreement, no payments, sounds great. Not great. So beware. If you want to connect me and my team, we're always happy to help, give you great advice. I was literally telling this to a lawyer in the hall, and he said, keep doing it, Matt. Keep telling as many people as possible. If you save one person from financial ruin, you'll have served a purpose. And so here we are, YouTube Live, trying to help as many people as possible. GreatMortgageBroker.com. You go there, you fill out the form. We can help you get pre-approved and get yourself started no matter what state you're in. If you want to send me a quick message just to get your answer on a specific thing. Hey, here's a question I have about this thing I'm in contract on. The new builder's telling me this. I just went under contract and want to get you to give me a second look. Just fire me a quick email, matt@mtmg.com. Thanks for watching. Till next time, we gonna see.